The pros and cons of investing in the stock market. When you invest, you're exposed to different types of risk. Learn how different risks can affect your investment returns. What are the pros and cons of investing in the stock market? The stock market has delivered generous returns to investors over time, but it also can go down as well, presenting investors with the possibility for both profits and loss, for risk and return. Investing in the stock market can offer several benefits, including the potential to earn dividends, or an average annualized return of 10%. However, the stock market can be volatile, so returns are never guaranteed. You can decrease your investment risk by diversifying your portfolio, based on your financial goals. But there is always still a risk. So, do your homework so that you understand the risk. Stock investing, the pros and cons. Pros. 1. Grow with the economy. 2. Stay ahead of inflation. 3. Easy to buy and sell. 4. You can build massive wealth. 5. You can start with very little money. 6. You can access your money quickly. 7. You can stay ahead of inflation. Cons. 1. You risk losing it all. 2. The returns are not guaranteed. 3. The stock market is volatile. 4. Takes time to research. 5. It takes time. 6. Emotional ups and downs. 7. You can lose your shirt if you don't know what you're doing. Let's dig into the pros of stock market investing, since stock investments can offer plenty of benefits. Number 1. Takes advantage of a growing economy. As the economy grows, so do corporate earnings. That's because economic growth creates jobs, which creates income, which creates sales. The fatter the paycheck, the greater the boost to consumer demand, which drives more revenues into companies' cash registers. It helps to understand the phases of the business cycle: expansion, peak, contraction, and trough. Number 2. Best way to stay ahead of inflation. Historically, stocks have averaged an annualized return of 10%. That's better than the average annualized inflation rate. It does mean you must have a longer time horizon, however. That way, you can buy and hold even if the value temporarily drops. Number 3. Easy to buy. The stock market makes it easy to buy shares of companies. You can purchase them through a broker or a financial planner, or online. Once you've set up an account, you can buy stocks in minutes. Some online brokers, such as Robinhood, let you buy and sell stocks commission-free. Number 4. Make money in 2 ways. Most investors intend to buy low, and then sell high. They invest in fast-growing companies that appreciate in value. That's attractive to both day traders and buy and hold investors. The first group hopes to take advantage of short-term trends, while the latter expect to see the company's earnings and stock price grow over time. They both believe that their stock-picking skills allow them to outperform the market. Other investors prefer a regular stream of cash. They purchase stocks of companies that pay dividends. Those companies grow at a moderate rate. Number 5. Easy to sell. The stock market allows you to sell your stock at any time. Economists use the term liquid to mean that you can turn your shares into cash quickly and with low transaction costs. That's important if you suddenly need your money. Since prices are volatile, you run the risk of being forced to take a loss. Now let's look at the cons or disadvantages of owning stocks. Number 1. Risk. You could lose your entire investment. If a company does poorly, investors will sell, sending the stock price plummeting. When you sell, you will lose your initial investment. If you can't afford to lose your initial investment, then you should buy bonds. You get an income tax break if you lose money on your stock loss. You also have to pay capital gains taxes if you make money. Number 2. Stockholders paid last. Preferred stockholders and bondholders or creditors get paid first if a company goes broke. But that happens only if a company goes bankrupt. A well-diversified portfolio should keep you safe if any company goes under. Number 3. Time. If you are buying stocks on your own, you must research each company to determine how profitable you think it will be before you buy its stock. You must learn how to read financial statements and annual reports and follow your company's developments in the news. You also have to monitor the stock market itself, as even the best company's price will fall in a market correction, a market crash, or bear market. Number 4. Emotional roller coaster. Stock prices rise and fall second by second. Individuals tend to buy high, out of greed, and sell low, out of fear. The best thing to do is not constantly look at the price fluctuations of stocks, and just be sure to check in on a regular basis. Number 5. Professional competition. Institutional investors and professional traders have more time and knowledge to invest. They also have sophisticated trading tools, financial models, and computer systems at their disposal. Find out how to gain an advantage as an individual investor. Here are a few ways to diversify to lower investment risk. One way is by investment type. A well-diversified portfolio will provide most of the benefits and fewer disadvantages than stock ownership alone. That means a mix of stocks, bonds, and commodities. Over time, it's the best way to gain the highest return at the lowest risk. A second way is by company size. There are large cap, mid cap, and small cap companies. The term cap stands for capitalization. It is the total stock price times the number of shares. A third way is to own different sized companies, because they perform differently in each phase of the business cycle. The fourth way would be by location. Own companies located in the United States, Europe, Japan, and emerging markets. Diversification allows you to take advantage of growth without being vulnerable to any single stock. And the fifth way would be through mutual funds. Owning mutual funds allows you to own hundreds of stocks, selected by the mutual fund manager. One easy way to diversify is through the use of index funds or index ETFs. In conclusion, before investing you should know how much of each type of investment should you have. Financial planners suggest you establish your asset allocation, based on your financial goals and where the economy is, in this current economic cycle. The balances you have for each investment do not include the taxes that will be due, the financial services fees accrued, or the charges for advice given. The information being presented to investors is without consideration of the investment risk, his or her financial tolerance, or the financial circumstances of each individual beyond the investment itself. For example, the amount of debt, job or income stability, etc. Which means it might not be suitable for all investors. They will always use the following quote to protect themselves from liability. Past performance is not indicative of future results. Investing involves risk, including the possible loss of principal. So, make sure investing is something you research fully, and that it will not put your current financial situation in jeopardy. Ask about all the costs, and make sure they are taking your whole financial situation into consideration. Will investing improve your finances, or would another option work more in your favor at this time? For more information, reach out to the person that shared this link with you.